The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And our Sunday best to you. Good morning and welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettler, along with Accunet Mortgages and Accunet Realty Advisors President Brian Wickert and licensed mortgage consultant and millennial David Wickert. If you have a question or a comment, as always, you can give us a call or text it in as well on the Accunet Mortgage talk and text line. That number is 414-799-1620. So we'll be revisiting the appraisal situation and also interesting advertisement here.
Yes, we've got a lot to talk about as usual. And by the way, this last Friday, the 19th of May, was a big closing day. I don't think anybody wanted to close on the Friday before Memorial Day, so I had a chance to talk to a lot of real estate agents. Turns out a lot of real estate agents, David, listen to the show, which is great.
Okay, good. Pressure's on.
Pressure's on, that's right. So we'll give you some stories that they had to share, too, some interesting things. But let's talk about appraisals, because I didn't feel like I did the best job when we talked about it last week or the week before. The lesson that I have from two real-life stories is that appraisals are not scientifically objective, okay? They are well-informed, still subjective opinions by human beings. And they're not the Lego pieces that you might be led to believe they are. You know,
or even if you look at an appraisal, they look like Lego pieces, but really any adjustment is still human.
That's right. All right. So like most human opinions, my theory and my belief, especially on a purchase transaction, by the way, is the appraiser kind of knows what the value of the house is going to be. Because, A, they know what the buyer and the seller agreed to. And then they kind of fill in the facts around that, okay? That's the way we do a lot of opinions.
Okay.
I'm trying to think of another analogy.
I love you. Now let me tell you why.
Or I really like that movie. I have that visceral feeling, and then I fill in the facts around it.
Okay.
All right, but here's the example that I have that I think most people could relate to. We did an appraisal for this fellow about 4 years ago in 2013. House appraised, this is way up north, Wisconsin, on a beautiful lake, 300 feet of frontage.
Wow. And
it appraised 4 years ago, 2013, for over $585,000. Wow. So time to refinance it for whatever reason. We come back now, $481,000.
Ouch.
We just told this guy his beautiful lake property is now worth $100,000 less than it was 4 years ago. How can that be, David? Why? How can that possibly be?
Blame your neighbors.
No. Blame your neighbors.
Well, isn't the point the only true measurement of value is stick a sign in the yard and field some offers? And as you said, an appraisal on a refinance is just, I don't want to say pseudoscience, but it's
pseudoscience.
Best guess. Okay, it is pseudoscience?
Well, it all depends on comparable sales, because the pool of closed home sales from 2013 is completely different than it is today.
I heard you this week say looking at an appraisal from 4 years ago is like looking at your investment portfolio from 4 years ago. You can't.
Yeah, it's like GE, IBM, whatever.
It's different.
It's different. That's a really good. Thank you, David, for listening.
Credit to you.
Okay. All right. So here's the deal. Let's say that comp number one sold for $500,000. Okay. And the appraiser judged that our property that we're trying to refinance is better by $50,000, let's say, because it's larger. And then he makes another adjustment the opposite way because this other sale has more lake frontage.
Sure.
So he makes that a $50,000 negative adjustment. So you got two $50,000 adjustments that cancels each other out, right?
Sure. Yeah.
But if you add them together, it's a $100,000 difference between the two properties, and that's what we call in the mortgage lending industry the gross adjustment. And the gross adjustments on any appraisal are not supposed to be greater than 25%.
As opposed to them canceling each other out, netting
would be
to
zero, right?
Okay.
That would be zero, is the net adjustment, but the gross would be $100,000, which would be on this theoretical deal, 20% of the $500,000. All right, so here are my gross adjustments. Remember, the rule is don't go over 25%. Comp number one was adjusted 40%. Comp number two, 19%. Okay. Comp number 3, 76% gross adjustments, followed by 34% and 43%.
Sounds like apples and zucchinis.
It
How
is.
is it the same?
And then on top of this, the appraiser, who's our local expert up there, right, is making these big adjustments based on the various lakes. And he's very convincing. Where does he say that about comp 1? Comp number 2 includes significantly more lake frontage. However, the locations on a peninsula. Comps number 1 and 3 were adjusted for quality of the lake frontage, and so I made a downward 15% adjustment. It sounds very scientific when you read that. I made a downward 15% adjustment in the value.
Why not 13?
Why not 12?
Why not 17? Okay.
We don't know.
It's the human part.
So this is my point. It's all about human interpretation of the facts. We'll let you know how this one turns out. I have a feeling we're going to have a problem in underwriting because of these big
75%.
adjustments. Very subjective. All right. When we come back, we're going to talk about an advertisement. I've seen a lot of billboards for this from a competitor, $999 off home loan closing costs. And now it's part of the magazine ad that I've got as a realtor staring me right in the face. We'll talk about that when we come back.
And if you have a question, you can reach us, call it or text it in at 414-799-1620 on the Accunet Mortgage Talk and Text line.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
The first-place Brewers look for their 5th consecutive win as they battle the Cubs today at Wrigley Field. Jeff Levering and Lane Grindle are live from Chicago's North Side at 12:45 today. It's sponsored by XPO Logistics. You're listening to the Accunet Mortgage and Realty Hour with Brian Wickert and David Wickert. Interesting ad here.
Yeah, did you have it right in front of you, Steve?
Yeah, I just pulled it up myself as well.
Okay, so the big headline, and I've seen this on billboards around Milwaukee as well, not necessarily lately, but they had it up for a while. $999, using numbers, by the way, off home loan closing costs, and there's an asterisk. All right, and then did you notice anything just when you looked at this? What kind of loan is that for? All loans?
No, it's an adjustable rate.
That's right. If you read the next little descriptive paragraph, which, by the way, this certain lender, which happens to be a credit union, which you usually think those are the good guys.
Oh, yeah.
They spell out the word 7 instead of putting the numeral 7-year ARM. I just wonder if that was intentional. By the way, I just looked up in all of the multiple listing service in the month of April, what portion, either as a percentage or one out of what market share do you think of the purchase transactions in April, Steve, used adjustable rate mortgages according to the MLS statistics? Any?
I'm just going to guess and say it's a low number.
Yep. Under 5 or above 5?
Under 5.
Yep,
under
3.7%. So that's what, about 1 out of 30?
Just about nobody.
Use adjustable rate mortgages. So this big headline, I'm holding it up here from the Realtors magazine and on billboards from a competitor of ours, is touting this amazing $999 off closing cost if you use a product that nobody wants or rarely uses. Mm-hmm. And I got to tell you, David, when's the last time you did a 7-year ARM? I mean,
on a purchase?
Yeah, on a purchase.
Maybe 1 or 2 a year.
Right. And, and it's not, I've done them. Usually they're for jumbos, but not the rank and file.
Well, but not when our advice is buy as much house as you can now while rates are low.
Right.
And be willing to be in that house for a long time. Well, in this case, year 8, suddenly your house is going to be a different expense.
That's right. So my point is that, we try to be super honest and transparent.
Well, and if you hop on a go-to meeting with one of our loan officers, we will show you side by side the difference between what a 7-year ARM is and what a 30-year fix is, or a 15-year fix if you really want to get after it, and give you the advice. And hey, if you want the 7-year ARM, power to you. But we're at least going to show you what the benefit is or is not.
The point is, it's rare. It's, super rare. This would be like if somebody at a gas station advertised a really great price on some grade of gasoline that you would never use in your car. It's the same thing. Okay. The only thing that's more rare, just by the way, than ARMS in terms of financing purchase transactions is a 15-year fixed. Only 1.7% of home buyers who used a realtor to buy homes in April.
You just don't want to strap into that.
That's right. Although I closed one on Friday for somebody that's buying with a 15-year fix. So we're going to have one of those in there. The other, just by the way, cash transactions. This is for the entire multiple listing service in April.
Can I guess?
Yep.
12%.
Oh, wow. Steve, you want to weigh in on this for the big jackpot?
I'm going to go with the 15% as well.
All right, 16.5. So pretty good. That's a combination of single family and
condos.
And condos. And remember, it usually skews heavier for condos. All right, what are we going to talk about
when we come back? I want to talk about how to do a home remodel. And we have differing opinions.
We do. $25,000 remodel. This was the question that came in from actually one of our relatives via text. And how should we finance that? We'll give you the answer when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Don't just find a house, find your home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
One of the most talked about issues in college sports is whether or not players should be paid. Marquette Athletic Director Bill Scholl shares his thoughts on that and more when he goes one-on-one with Doug Russell as part of our WTMJ Conversations series. And conversation will start up at 11:07 this morning. Our conversation right now, though, centers around a $25,000 remodel.
That's right. So one of my nieces and nephew-in-laws left me a voicemail on Friday and said, "Hey, Uncle Brian, what's the best way to go financing? We want to do a $25,000 home improvement on their home in the Fox Valley." And so I said, "Well, tell me, what do you think the house is worth now?" And so the answer they came back with was about $228,000. We had provided a VA loan for them when they bought the house back in 2013, so that balance is down to $165,000. All right, so the choices in our answers are, well, I could lend you 80% of the new value of the house. Let's assume it just comes in at $228,000. And the problem is that I could only lend $16,000 new dollars because on a regular 30-year fixed-rate Fannie Mae loan, I can only lend you up to 80% of the value of the home. Okay. Then, and by the way, the payment on that would be about $80 more per month.
Because we're limited, I can only lend you up to 80% of the value of the home.
Correct.
On a cash-out refinance.
That's right. And then what we could do, just by the way, is we could come back after that. Oh, but the rate on that, by the way, is 4.25% for the new 30-year fixed-rate loan. Their current rate on the VA loan is 3.75%. So they're going up 0.5% in rate on the whole balance just to get them $16,000 of new money. So I'm not really fond of that. Okay, well, the cool thing about the VA loan, and thank you, nephew-in-law Matt, for serving in the Army and going overseas to Iraq and actually, being in combat, and now he's in the National Guard. We could give him another VA loan, but the thing I don't like about that is then we have to pay the VA another 3.3% of the entire loan balance, which is like $6,700. $6,448 to be exact, just to get them the $25,000. So I really got to lend them like $32,000 in order for them to net $25,000 for the remodel. Now the good news is the rate would be good on that again because of the government loan, but I really have a hard time saying, hey, you're going to spend, even though we're going to roll in a new loan amount, $6,500 to borrow $25,000. That seems like a bad idea. But you think that's maybe the way to go?
I think you're correct. But part of my answer to you is human. It's last week we talked about the mortgage interest deduction, and people don't think about the expense or cost if it helps them do the thing that they want to do. And so if it gets them extra money in their pocket, they're not going to notice the VA funding fee because it's going to help them increase perhaps the value of the home, increase their enjoyment of the home, and if that cost is amortized out for as long as they hold that loan, I just don't.
Maybe it's okay.
I don't think it's going to be the thing that gets in the way.
I think that the way we should do this, though, and David mentioned GoToMeeting. That's the software that we use so that our clients can look at our computer screen. I would want everyone. Let's talk about this at the sales meeting on Wednesday. Faced with this situation, I think it's our duty as mortgage practitioners to point out, yeah, I can do this on a VA loan, but it's going to cost you $6,449. You're not going to feel it, but we're lending you an extra $6,400 to cover that VA guarantee fee. Okay, the other two options real quick are, and this is what I'm going to recommend, we could help them get a 15-year fixed second mortgage. Now, the rate on that is going to be higher.
Because it's in second position.
It's in second position, and, we're leaving him with less equity. That's going to be 6.15% with a payment of $213 a month. Or we could give him an adjustable rate second mortgage where the interest rate is fixed for 5 years at 4.99, amortized over 20, and that only has a payment of $134. They do have some adjustable rate mortgage risk in the future, but I'm leaning that way because it's going to be on such a small amount that when the rate changes in the future, it's not going to hurt them. All right. So that is the kind of analysis and transparency that we try to bring to every scenario, whether it's to buy a home or refinance when people come to us. And I'm always happy to help our relatives, especially. But you know what? We'll treat you like family if you call or click on the blue button anytime. All right, when we come back after the news here, we'll do a quick little rate roundup, and then we're going to talk about how many trillions of dollars do Americans owe on things like mortgages, home equity lines of credit, student loans, car loans, and what are the delinquency rates when we come back after the news.
Right here on the Accunet Mortgage and Realty Show. It's now 10:30 as we welcome in from the WTMJ 24-hour newsroom, Colleen Bolin.
Thank you, Steve. Speaking to leaders in the Middle East.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
So we'll jump into a rate roundup, and then we're going to take a look at just how much money we owe out there.
It's a lot.
Yeah. All right. So at the end of business on Friday at Low Overhead Accunet, located in lovely Butler, Wisconsin, Accunet could offer on a $200,000 loan with 25% equity and all the other right stuff, 3.99% on a 30-year fixed with just $300 in closing costs. The APR is 4.004. And just to compare that to the 7-year ARM we were talking about earlier, so Accunet could deliver 3.5%. Ooh,
0.5%, yeah.
With an APR of 3.78. That's with regular closing costs of $11.80. Dad, what do you guess the difference in payment is between?
Well, I'm going to say $80.
56.
Oh, only $56
a month. And so, hey, if you want to win the bubbler conversation at work, like, oh, I got 3.5% on my, loan,
right.
That's fine. Then that advertisement it's all about you.
Yeah.
But the difference in the first 7 years, you would only pay off an extra $1,900 in principal. Okay. Which is the equivalent of, you could just set aside $25 a month for 84 months and have the same amount of savings.
Right, but you've been enjoying that $50 less payment. Anyway, most people are risk averse. Correct. We know this about human behavior, and so unless they know, like I've had people say, hey, I've moved every 5 years because I'm with XYZ company. I am not going to be here to see this rate adjust.
Okay. I'm risk averse, and it's just like, well, hey, what if you end up, staying here longer?
Yeah. It all depends. Very few people, only remember 3.7% of people buying houses chose ARMS. Okay, what about a 15-year fixed?
On a 15-year fixed, Accunet could offer 3.25% with only $600 in closing costs. The APR is 3.265.
Wow.
And then the 20-year, I don't know how many 20 years we really do.
More than you think.
Okay.
Yeah.
3.875% with regular closing costs of $1,100. APR is 3.8.
Yeah, the 20-year fixed is great for refinancing. If you're 5 years in, a lot of times you can go to the 20-year, which has lower closing costs, let's say. The rate is awfully similar to the 30-year, but it's just priced a little bit better, so typically the closing costs are less. Anyway, Good tool for refinancing. All right, now let's. The New York Fed has a division, I guess you'd call it. Let me
The
see.
debt division?
What's it called? The microeconomic something or another. And they came out just this last week with the headline, Household Debt Surpasses its peak reached during the recession in 2008.
So congrats to all of us.
So, and actually what happened was people paid down debt during the recession.
Good.
Which was good. And it bottomed out in 2013, and now we have set a new record. Okay, and the record
Popping
is
champagne bottles.
What is the total?
That we borrowed the money to pay for.
$12.43 trillion with a T dollars worth of debt, and it breaks down like this: mortgage debt is now $8.6 trillion. That's the granddaddy. Home equity line of credit debt is only $456 billion.
Only.
That's about 1/20th.
Okay.
The total of mortgage debt. And by the way, that is down. So people are doing what we're advertising. They're paying down or consolidating their home equity line balances. Why? Because they're adjustable. And what did you just tell me before, David? What are the chances now of a Fed rate hike on June 14th?
74% odds.
That's high.
Yeah.
That's a virtual certainty. And when they raise rates, the prime rate's going to go up. All home equity lines of credit are tied to prime rates, so
Credit cards too.
Credit cards too. Okay. Student loan debt is in next place, $1.3 trillion outstanding,
So
followed by auto loan debt at $1.17 trillion, credit card debt only $764 billion. Oh, that's a total of $12.7 trillion. All right, now let's talk about delinquency rates. Or actually, you know what? We'll do that after we come back from the break. What percentage of people in each of these categories are seriously delinquent, meaning 90 days or more late on their payment? We'll give you those astounding numbers when we come back.
Right here on the Accunet Mortgage and Realty Show.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, the greatest show on earth will come to an end this weekend, and if you can't make it there in person, it'll also be broadcast on Facebook Live. Is this the new norm? Gene Miller takes a look at 7:50 tomorrow morning on Wisconsin's Morning News. Right now, it's Brian Wickert and David Wickert, the Accunet Mortgage and Realty Hour here on WTMJ.
Just because I want you to know I'm well-rounded, I read an article about the Cannonball lady from Ringling Brothers in Barnum and Bailey. She pulls 7 G's coming out of that cannon.
Not $7,000.
Not
you mean
gravitational?
Wow.
Yeah, that's like a fighter pilot.
Don't you throw up at like 1.5 or something?
You know what? I probably would. Okay. Anyway, back to mortgage delinquency number, or all delinquency. All right. So now keep this in mind. Mortgages are collateralized by the home, right? Meaning if you don't make the payment, they get to take your house away. So are home equity lines of credit. Car loans are collateralized by the car. You don't make the payments, they come and take them away. So the two kinds of loans, I'm giving you a big fat hint here, Steve, that are not collateralized by anything are credit cards and student loans. Which of those two? You got a 50-50 chance here, Steve. Which has a higher delinquency ratio, student loans or credit cards?
That would be student loans.
You are correct. And the official number
Can't
is
take your brain away?
11%.
Can't collateralize your head?
That's right. The delinquency rate on student loans, according to the New York Federal Reserve, is 11%. But, David, I emailed you the language for the footnote. Do you have that?
I do. Footnote explains in a previous report that delinquency rates for student loans are likely to understate effective delinquency rates because about half of these loans are currently in deferment or grace periods or in forbearance. Yeah. And so they're not paying back, and we're not including them. So that implies that among those loans might be twice as high as what we're estimating.
Yeah, it's higher.
So the federal 22%, 1 out of 5 student loans is seriously delinquent, meaning 90 days or more late. Yeah. That's bad for us taxpayers, just by the way, because
we're all on the hook.
We're the lender.
Yeah.
Okay.
But we got good news this week and last week on student loans in the mortgage. Mortgage World's trying to do their best to help out on student loans.
That's right.
Previously, mortgage guys like us had to use a payment according to your balances. So if you owed $20,000 in student loans, I had to, at a minimum, pretend like that was a payment of $200. That's 1%.
The 1% rule.
The 1% rule. If only because what we were trying to calculate was, hey, hey, when you do start paying back on those student loans, let's make sure it doesn't blow up the rest of your budget, which means get in the way of helping you pay back your mortgage.
But we threw that out
but
there.
now,
Fannie Mae and Freddie Mae said, forget that.
Yeah. Now, if there is a payment listed on your credit report, I get to use that.
Which is normally, I would say at least half the people we see with student loans are making income-based repayments, which are smaller than the required principal and interest. In fact, they're paying no principal back. Okay, so their loan balances are actually going up, but we can now use that income-based payment to qualify. All right. So then the second place for delinquencies is credit card debt at 7.5%. That's pretty astounding. 1 out of 13 borrowers are more than 90 days late on that. Auto loans, 3.8% are delinquent, seriously delinquent. Home equity lines of credit, just 2.1%. And thankfully, in the mortgage world, down to 1.7%. That's really good. So good job, everybody, on paying back your mortgage loans. That's
owe
all.
A lot, but yeah.
Yeah.
Proving nobody owns anything? I mean, is that the...
Keep on paying it back. We had, like I mentioned earlier in the show, a lot of closings on Friday, this past Friday, the 19th. Had one nice compliment from a very seasoned real estate agent at Shore West who said, hey, she's starting to use our suggestion when she has to give the seller the right to cure defects. She is now including language that says, but if the seller elects to cure a defect, buyer and seller must agree on the manner in which the cures will be made.
Nice.
So she's adding that. And her manager noticed and said, where did you come up with that? She said, well, the Accunet Mortgage and Realty show. So I was feeling kind of proud. That's really, I think that, we've talked about how important that is, but I'm heartened that people are finding value in what we're talking about on the show. The other agent I talked to, one other really astounding comment, had to do with his prediction and observation about what happens this time of year with the number of buyers. I'll give you that really interesting observation when we come back.
Right here on the Accunet Mortgage and Realty Show.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert, David Wickert with us here on the Accunet Mortgage and Realty Hour. So at this time of the year, an interesting thing happens when it comes to buyers and sellers.
Yeah, this real estate agent pointed it out. It makes sense. I don't have any data to prove it, but he says he's observed this the last 2 years, is that right about now, the pool of buyers, the competition, if you're out there looking to buy, starts to shrink because of millennials' apartment leasing cycles. He says, when you come out of college and you get your first job and you sign that lease, it's usually for a year. And when do you typically sign that lease? June, July, maybe, depending on when you find your job. Mm-hmm. And so people who haven't found a home, let's say you're a millennial and you've been out shopping and you haven't found it, right now you got to decide, am I going to renew my lease for June or not, or July? David is smirking. Millennial representative says.
Yeah, let me speak for all my brethren. I mean, you know what? That sounds like a good theory. But you can go rent a place just about any time of year. I mean, yes, you might not have your pickings, but
doesn't the landlord want you to renew? Like, hey, okay, sign another year. I mean, you have to negotiate your way through that.
What's that?
Because otherwise it's an increased month-to-month rate, right?
Yeah, do they jack you up? I suppose it depends on the terms of the lease.
Yeah.
I just don't think that's going to reduce the. When I walk into closings this week, my bad joke is, so how was the house hunting experience? Were you pushing people out of the way to get into the home right after it was listed? Because as we've said, good homes are, even okay homes are going quick, and good homes are going even
quick with
quicker.
Multiple offers.
Yeah.
One of my favorite real estate agents, I was with her at a closing on Friday. She said she had a listing in like the $300,000 range in Brookfield, and on the first day, she kind of ended up having to do an open house kind of style because 26 buyers came through the house on one day.
Yeah.
Literally,
wow.
You were there with other people, speaking of sharpening the elbow and,
right.
getting them out of the way. So will that abate? I don't know. I did have a couple that I was talking to, David, just kick back their lease for 3 months to the end of September because they hadn't found anything yet. Okay, so it does happen.
Part of it, can I just say, part of it also depends on the price point of where you're looking. $300,000 in Brookfield, hot market.
Yeah.
$200,000 in Wauwatosa, hot market. $400,000 in Mequon,
yeah.
hot market.
Okay.
So, I mean, again, you know what? If there are fewer buyers, awesome. You know what's going to help you win when you're competing against other offers?
What?
Being rock solid.
There you go. Of course, I mean, that was like a bait. That was like a setup. Yeah. The rocks, and that's the other thing, though, that I am hearing from real estate agents out there for sure on both the seller side, because I'll ask them, hey, did the rock solid pre-approval help? And they say, absolutely.
They're not just blowing smoke?
I don't think they're just blowing smoke because people are recognizing there's a difference between the slapdash pre-approval you'll get from a big bank like, I don't know, Chase, that just says, hey, I checked your credit and you're good to go. And then we're saying, nope. We not only checked your credit, we verified your income and we verified your down payment, which are actually, more important, frankly, than the credit. You were going to say something, Dave?
I was talking to a young guy at the end of business on Friday, and what I said was, you could tell, in your example, Chase, that you're the starting quarterback for the Green Bay Packers, and you make $500,000 a year. No, you could. Honest to God, you could. And they'd say, sounds great. You can go out and buy a house.
Yeah.
Because there's no, that's extreme, but there's no documentation to prove that you aren't, other than I don't see you, on
Sundays with the number 12
afternoons.
on your back.
Right,
Yeah.
but the point remains that without the extra level of
Diligence, you don't know.
And what I enjoyed, especially to defend my millennial cohorts, we're a smart bunch. And so when I describe to, in this case on Friday afternoon, put yourself in the shoes of the seller.
That's all you got to do.
Who do you want writing an offer on your home? I want the person who put on their adult pants and did the homework to be ready to buy my house, because it's all a measurement. It's all a measurement of risk. It's to say, hey, I've got 4 offers because my house in Brookfield for $300 is hot to try.
Yep. How am I going to compare them? How am I going to decide?
Well, yeah, but it's when you pick, you are picking someone who makes you feel the least risky.
Right.
That they can deliver on what they're offering to buy your home.
One other thing that came up, you just jogged my memory. One of the first-time home buyers who I went in and said congratulations to, it was the letter that she wrote. Don't forget that. When you're competing.
Personal letter.
The personal letter to the seller. The seller, get this, was selling his the home that he grew up in. So it was his parents' home that then his sister had also lived in. So this...
A little bit of emotion there.
Oh, a lot of emotion. And he said, he kind of teared up. And when he was telling the buyer that, because they came in after, he's kind of getting choked up even just retelling.
Of course.
Reading of the letter. So, you got to pull out all the stops.
When you're competing.
When you're competing, so that personal letter, the rock solid pre-approval letter.
I've seen people include pictures. Like, this is our adorable family. Please pick us.
And now
the
new
dog.
thing.
Don't forget the dog.
Don't forget the dog or the child. The new thing, David, is videos.
Wow.
Yeah, a little video message.
Here's our documentary, commercial about us as a buyer.
Yep.
It's a whole new industry.
That's the new level. What else can we say? Oh, I got an ad running right now, my 60-second commercial, reminding people that it does not take a full percentage reduction in your interest rate to make a refinance worthwhile. If you can lower your rate just 0.5%, let's say from 4.5 down to 3.99, and if you took your loan term from 27 years remaining to 25, because remember, we can customize your new loan on a refinance.
And show you that on our screen when you're looking at it with us.
To any number of years you want, between 10 and 30. So if we shave 2 years off your loan term and lower your rate by 0.5%, that will save you, are you ready, $27,700 of interest. That's a lot of money.
That's real money.
And we make it convenient. Look at our screen. We got all the e-sign stuff. Sometimes we don't even need an appraisal on a refinance. We'll even send the closing agent to your home or office to conduct the closing. Although we always love it when you come into Low Overhead Butler, because then I can swing in and say hi, maybe give you a parting gift, something like that. All right, take advantage of rates while they're still low, folks, because we don't know how long they're going to stay low. We'll be back here at the same time next week. That's all we got for today, Steve. Thanks a lot.
And we'll check in with Colleen Boland next from the WTMJ 24-hour newsroom.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.